Okay, just doing some sound check. And let me look at my sound check values. Looks good here. If there is anyone right now watching, please let me know if you are getting sound. Okay, we have 5 people joining us. I'll wait just a little bit for more. For those of you that are here, please just let me know if you can hear me well, if the sound is coming through. Okay, sound is good. Thank you, Eric. Well, let's start with this so we can end on time. And as usual, it is always a recording. And the good thing with YouTube is that it's like more like video on demand. You can, when you arrive, you can watch this from the beginning if you want. So even if you miss a little bit, you can always go back and watch it. So let's start right away. Let's start talking about the NDLA. Now, the first thing is, what is the performance of the DLA right now? Of course, back in May, we have a 0% performance on it after the fall. So what is NDLA right now? So we can see it right here at the variance center is about 45% precision, which is not bad at all. It is 45, I will say, is recovering nicely and is, to me, is arriving at the long-term precision that NDLA has had, which is around 50, 60%. The only bad thing is that the naive is also having 45%, which is not surprising because I don't know if you noticed, the NDLA just generated a string of positive signals, like 20 of those in a row. So basically for the last month, it actually behaved like the naive strategies. So there was an overlap between the two, but I'm happy with the performance. The performance is actually not that bad. Right now, if you notice, NDLA 2.0 is generating a lot of negative signals, but a lot. It has, let's see, it has 6 in a row right now, or 5 in a row. So while the classic NDLA only has 1 negative signal so far. So I will say that the market is at a level where both NDLAs are not getting comfortable with more upside. I don't know what it is. If you remember, those are neural nets that were trained. So it is hard for me to come up with an insight that tell us what could be, what could be the reason for the negative signals. The only thing I can conclude here is that most likely the market will remain range bound for the near term. That's what we can conclude. Remember, negative signals, they don't mean that the market is going to fall. So don't confuse. A negative signal just doesn't mean it just means that the market is not going to get up 1%. But that doesn't mean the market is going to fall or is going to crash. So given where we are in the market, I really think that the market is going to be range bound. We are going to stay in a little range, and the range will extend all summer long. That's kind of my take. So let's look at some questions. I have a question from Ray here. Due to the divergences between the two NDLAs, which one is more accurate? Well, everyone has different strengths. Now, NDLA Classic, I think, has higher precision, but NDLA 2.0 has higher recall. And from a statistical point of view, higher recall means that negative signals have more chances of succeeding. In other words, the NDLA 2.0 has less false negatives. I correct myself. So I will say that it's very likely because of the high recall that NDLA 2.0 has, it's very likely that these signals are going to be correct, and like most of them will be correct. That's why lately I have not been taking the NDLA trade, even though it looks very, very juicy and really tempting to take. I'm not taking it because NDLA 2.0 is very likely to be correct on the negative side. So it's very interesting. NDLA Classic has a little higher precision on the positive signal. So if I see a positive signal on both of them, then it's kind of a no-brainer, no? If I see a positive signal on NDLA 2.0 and no signal in NDLA Classic, then I'll take the signal, but I will be kind of afraid. And right now, if I see a negative signal in NDLA 2.0, I'd rather don't take it. So it's kind of a mix right now. I am working on merging the two algorithms right now. That's my current work. So we use only one going forward. But so far, I think performance has been within the parameters of the training of the nets, and I think they have worked really nice. That was the question for Mitch. Well, for now, Mitch, I think I will continue to use them probably the next month, but then I will switch to a single version that combines the two strengths. So that's my homework right now. I'm doing the homework of merging the two. So let's see what else we have here. Sorry about this, I always forget where I am. Okay, that's all of interest is that NDLA Classic is about to flip negative today. That's very interesting because for those of you with long memory, you can see we have more than 20 positive signals in the last month. Basically, for the past month, every day, every session, we have gotten a positive signal. And notice today, we have a negative signal. That's something that should is telling us, sending us a message. Something has changed in the market. We better listen to it. NDLA 2.0 has started sending us that message for a while, since June 7, but now both seem to be on the verge of agreeing. And I think that's the signal I needed to close my lungs and also close my my downside hedges. And the reason is, I think what this means, given that we are in a long gamma regime, what this means is that the market most likely will be range bound. My thesis for range bound is a combination of a bunch of stuff, and I guess the strongest source of my thesis is from seasonality. We have seen for the last 10 years, summers tend to be very quiet, with very few exceptions. I mean, at least June, July, and most of August tend to be really, really quiet. And I think seasonality is showing itself right now with the low amounts of realized volatility we are seeing at this particular time. So let's move on. Let's look at current positions. So right now, we only have one position open. I mean, even in my own private book, I only have one position open. So I close everything, every single thing. I am flat. And the only thing I have is the September butterfly, which is you guys also have. And if we look at the gamma tracker, it's right here. So this butterfly is performing decently. I cannot believe how good this thing is performing. We established this butterfly as a downside bullet, something that will really shine if the market fell extremely hard. And it hasn't happened. Market fell a little bit, but it's not quite. Now we are almost back to where we started. And just the butterfly, look at that. Mid price is almost break even. So it is a champ. This particular trade is behaving tremendously well. So that's the reason I am keeping it, and also it's very cheap. It's only 35 cents. We only need something to happen. I don't think that anything is going to happen over the summer. So I will reevaluate this position eventually mid-July, and see if it's worth keeping it, or maybe we just wait and we look for something else for September. The good thing is this is for September. Plenty of things can happen, and September always exhibits increased realized volatility. And of course, as a reminder, folks, you can always ask questions in the middle of this. If you have questions, just type the questions, and I keep checking them. So that's the only thing we are writing right now. And then you can see the historical trades. This is actually the record of historical trades from the Gamma Optimizer room since probably the start of the quarter. No, I mean, we only have this trade that we closed on the 29th. I am including it as the beginning of the quarter because that's when I started tracking this. So since we started tracking these things, it has behaved really well. We have had a tremendous rate of success. Of course, we have a period of underperformance here and there's 3 negative trades. They were kind of painful, but as the nature of the beast, no, we had, that's well, we were prepared. We were prepared for this kind of underperformance, and then, but anything else, I think it has worked really well. Notice that I closed early the NDLA trade for June 14. I mean, I sent an official close for this trade early, but I know some of you missed the close and are still riding it. So congratulations, now you're going to get a jackpot on this thing. We're very likely that you're going to get a jackpot on this thing tomorrow. It's going to be a very fantastic trade, and it should be up a lot right now at this time. So if you don't want to wait, you can close it today. There is no shame in banking 150% return in less than a week. No one should be ashamed of those kind of returns. I have a question from Chuck. If the butterfly is still in play, well, Chuck, the butterfly, yes, you can open it if you click on the link. I know that this particular software that I use to broadcast doesn't show my mouse for some reason in Mac OS, but the link will give you the details of the butterfly and the rationale for the thing. If you really truly believe in big downside, I mean, if you truly agree with the thesis, the original thesis, of course, remember this thing was done back in April when we still thought that the market could fall really hard. So if you still think that that's possible, yes, this is a fantastic trade. This is one of those trades that will bring the house down, as they say. This trade will light up. It probably will touch $4-5 if we get a massive down. But right now, I mean, it's cheap. You can get it for 30 cents, 25 cents. Go ahead, get it, but be careful with it. I mean, just remember that you're risking the full premium for it, no? That's the thing. Okay, so I have a couple questions from Jim about the yes, Jim, the NDLA performance tables are all 5 trading days forward. However, about 40% of the signals occur when there is no an option expanding. Yes, 2 out of 3. In those cases, we need to go 6 business days. Could you either add a column to show the 6 business day return? Yes, we could do that. And in fact, for the historical tables that I put, that's what I do. I use the correct closing value. So most of the time, when the signal is correct, the signal only has to go 1 extra day. So when the signal works, it actually works the extra day. So it's something very interesting now. I guess is if the signal has been strong for 5 days, it usually is strong for 1 extra day. Going back on my historical data set, I never found a case where the market actually came back on the 6th day. So yeah, the signal was fulfilled on the 5th and also on the 6th, and that's what I found on the performance tables. So even though it's an approximation, Jim, it's a very accurate approximation. Right now, the table that I am displaying right now is a very accurate approximation, but yes, I could do that. But remember, the stats that I am displaying are more the stats of the algorithm itself, and those are not the stats of the trade. I am not even excluding, on the table that you see here, I am not even excluding the signals we didn't take. We got 20 signals just in the last month. We didn't take 20 signals. We took, 5 or 6, that's it. So this table is more about the algo itself, but not of the trading we do on the algo. I could develop a table that takes into account the real opening and closings, the moments that we actually enter the trade and the moment where we actually close the trade. That's something that certainly can be added. Okay, So let's see what else I have here. Okay, the return of the portfolio. Well, I am very happy. Even though we have some underperformance, if, remember, when we talked about the Kelly criterion last week, I recommended for the NDLA trades, I recommended using one contract for every 2,000 that you have. That's kind of an aggressive portfolio, but it's not bad. I mean, if you can spare 2,000 for the gamma optimizer room, and I hope that the 2,000 is just a fraction of your total. Don't spend all of your, if you only have $2,000 as your fortune, please don't do this. I mean, it's only if you can risk the 2,000, no? So if you can risk the 2,000, this portfolio has delivered 77% return on it, and all documented trades. Of course, there is an amount of slippage in commissions and fees, but I think there's a very decent return for a quarter. I think 77% per quarter is not bad at all. I'm happy, I'm content. In my trading, it's about the same, even though I do other things that I don't post in the room. I think it's just about the same. So I'm happy. This quarter was a very good quarter in general. There is still a couple of weeks left, but so far I think I'm going to take it in a wait and see approach. My numbers are really nice and really up nicely. So I'm suffering from, in fact, I could close this for the whole year. I mean, if I were running a hedge fund, this is the moment I will just stop and don't even trade anymore the rest of the year, and I get to show 77% return. I'm just kidding. You know, I keep trading, but I mean, it was good. In terms of performance, I am very pleased with the results so far. Let's look at volatility. So I am looking at the realized volatility. You can see this is the line that I'm looking right now at this time. So we can see that I'm going to make a few comments. In terms of very recent volatility for the past week has been very low. 9.78 is very low. Clearly we have seen a dramatic slowdown in the market for the last week. And I think it's related to summer, it's related to seasonality, it's starting to chop right now. So we'll keep an eye on this number. For the past 2 weeks, it has been a little elevated. I guess we got that little volatility, mini volatility event, which wasn't that big, but it was okay. And also, for the past month, it has been 13.61%. So it has been not bad. Sorry guys, just excuse me for a second. Just excuse me for a little sec. Okay, I got some noise in the background, sorry about that. Anyway, in terms of volatility, I was looking at volatility, is low in the last week, high, kind of high in the last week, but for the last month, it hasn't changed. Volatility has remained exactly the same. It is interesting that it has remained exactly the same. Despite everything that has happened, nothing has happened actually in the volatility world. For those of you with a good memory from the May video, it was basically the same. So the market has pretty much done nothing for 2 months now. And this thing is also reflected in the instance of VIX and VIX 90. The VIX is the same value that was a month ago, and VIX 90, which is the expectations for next week, is actually a little lower. But in general, nothing much has happened. This is kind of the history here, the story that we are telling, that is that nothing has changed. Okay, I have another question. I know that NDLA and EWT are totally different creatures, but can you comment on the relation or non-relation? Okay, Jeffrey, yes, of course. Just making a parenthesis about that. Yes, NDLA is a very specific pattern, it looks for a very specific pattern. And if you notice, the pattern that it looks for is only for 1 week forward. It's only 7 days ahead. It's a very, very short-term indicator. And yet, you can have successful trading with those kind of indicators, and it's very suitable for some kind of trading, for swing trading with options, because we exploit convexity in options with the NDLA, but it doesn't tell you anything else. I mean, that's the only thing it is giving you. It's giving you just a view 1 week away, and it's only giving you a view of a very particular pattern. It is not telling you if the market is going to fall. It doesn't tell you anything like that. So EWT, on the other hand, can provide a bigger picture, like going forward. You can see more or less where we are. We are in this wave, and we are expecting to start now a wave down. That's kind of the expectations. So it helps you, EWT helps you prepare for a longer term move, if you will. That's kind of the difference that I see between the two. And I think it complements nicely. It informs our trading to, in the Gamma Optimizer room. So far we have done the NDLA for this year mostly, but as I am about to mention, we're about to switch to a different strategy for the summer months. And that strategy will use a little bit of my own insights and also the expectations from the EWT experts. Okay, so in volatility, we just reached the conclusion that nothing has happened. Now let's look at the expectations, and this is a question that I got in the room. Right now, seasonality favors very low realized values. That's favored by seasonality, and that's my default expectation going forward, because that's what it is. I mean, I have a statistical edge just right there. However, we have important macro events over the summer, and the two most important macro events we are having is a Fed meeting next week. However, the nature of the Fed meeting is very interesting. The only effect in the market is an upside surprise. That's the only thing it has. So the Fed meeting won't have a downside surprise. I mean, I don't see how, unless those so the only thing that can happen is that they decide to cut rates early, and that will be an upside surprise. It's debatable. I don't think that I might play it if I can get a position that costs 10 cents and pays $5. I might risk 10 cents for $5 if we find something like that next week, or just in case of the remote probability on upside surprise. But I'm not counting on it. We also have a G20 meeting, and in fact the term structure is inverted around the date of the G20 meeting, and that is a trade right there. I have a trade. It's building on my mind. I am preparing for it mentally for this trade, because nothing will happen in the G20. We know, everyone knows there is the likelihood of anything happening on that meeting, anything good happening on that meeting is very low. So we could develop a trade, and the trade we could develop for the G20 meeting is this one. Notice I cannot point in this. I don't know. I'll let you with your eyes look at this peak. There is a peak. You notice that there is an inversion around probably just before the 30 days. There is an inversion, just about 16%. And that inversion is not a coincidence. It's a product of the G20 meeting. My idea to play the inversion, so the market is inverted. I have a point here, and then later on I have a point down. I don't know how it looks I think it looks like this. But in your mind, just translate this. And my idea is that the term structure will normalize after the G20 meeting. But I don't know the levels. I don't know if the term structure will fall or will move up or everything. But what I think is the inversion will end, and even though volatility might remain elevated, the term structure will come back to the normal shape. So there could be a play in that space, and I am designing the play. When I have something decent, something that I can show you, I'll show you, and I'll let you know about this. Okay, so Ray says, the market has been relatively weak this week, hence can we still keep the long-term SPX hedge, vertical put spread, and put butterfly? Well, I closed my SPX hedge. You can keep it. I mean, you can do anything in Fox with the positions you have. You don't have to follow me in the way in and the way out exactly. But my rationale for closing the vertical spread for the end of August is that the only reason I opened it was to protect my NDLA trades. So I have these NDLA trades going on, and we have long weekend uncertainty. We have all sorts of things. So I open it just as protection, as a hedge. And because I am flat right now, I don't have anything. So there is, for me, there is no need to protect anything. And the 10 cents it cost me, like I lost 10 cents on the trade. It's just the cost of insurance for me. You know, it's actually very cheap insurance. So it's up to you. If you really strongly think that the market is going to break down before August, I guess it's a great trade. It's a 10x trade. It's a trade that will deliver almost 10 times the cost. But I don't know. I personally, I don't believe it will break down before August. So that's the reason I close it. No, but you can keep it, of course. But just be really careful with it. And I'm keeping the butterfly just in case. To me, the butterfly is the one that will capture everything. It's the easier one to keep in the books. Finally, just because the live video is getting a little longer, like we arrive at the meat of the meeting, is the short vega trades. Okay, so now that I have this particular thesis that the market is going to be range bound, I plan to start short vega trades. And it's very simple. Those trades are contingent with the world not ending by June 30. I mean, if after the G20 meeting the world doesn't end, hopefully, then it is the signal that we can start scalping volatility here. And we have 4 ways of doing it. We can do this with butterflies. We can scalp butterflies, and by scalping I mean we can establish short-term duration butterflies. We could delta hedge them or static hedge them depending on the cost of hedging, just to capture the difference between the two. All depends if there is enough juice on implied volatility for it, but that's one way to do it. And of course, when I do that, I'll explain to you in detail how the trade works. But just so you can prepare for it, you can read about butterflies, you can prepare and become familiar with the terminology. We can also do calendar trades to extract changes in the trend structure. I think calendar trades are actually really, really good here because the trend structure is so inverted and so flat. We could get a calendar trade that bets on the slope going a little steeper on the trend structure. And I want that to be a pure trade. I don't want that calendar trade to be dependent on the levels of the market. So I think it's going to be a delta hedged calendar trade. Again, it could be dynamically delta hedge or it could be a statically delta hedge. But the whole point is that it's a pure term structure trade. It's not going to be price dependent. Finally, we can also, well, not finally, I mean, in addition, we can also use a strangle swap. And a strangle swap is something that the old-timers in the room know that I like to use for earnings. When I do play earnings from time to time, you know, once in a blue moon that I play earnings, I like to do strangle swaps. But this is one of those cases where the strangle swaps could work really well in the market because we can have a short strangle, let's say for August, and we can have a long strangle for September, you know, like a month later. And I know that September volatility will actually be fairly consistent, while August volatility, if the world doesn't end, will tend to fall. And we can capture the fall of volatility. And the trick, as usually, the devil, as usually, is in the details, is how far the strikes of the strangle should be, what is the region where we are going to profit from this. But I'll model this, and I think the strangle, I have a hunch without running any numbers that the strangle will be superior to the delta hedge calendar trade because the strangle swap is more statically hedged. It's basically self-hedging. so it hedges itself. So I think that will be an interesting one. And finally, this one is for those of you that are actually brave. I have noticed that I have brave traders in my room. But the most profitable strategy will be to use risk reversals, long or short. And risk reversals, I think, will deliver the goods during this particular juncture. And of course, I didn't put it here. Let me correct this thing. Binary risk reversals. This is very important. They have to be binary risk reversals. That's the key of making money. So I think binary risk reversals will be the secret for this. Of course, the only thing I have to do is, as usual, whenever I have some time, I have to go over all the 4 and see what comes ahead. 2 might come ahead, but I think we'll do at least 1 or 2 of these over the summer. In a systematic way, we keep doing them, we'll keep doing them. So those are my plans for the summer. And finally, Q&A. So any questions? Just let's use the time because it's half an hour already, and I wanted to have a short presentation, but you know, I open the floor to you folks. You can type the questions on the window, and I'll answer them. I know there is a delay between my voice and when you type, about 20 seconds. So I'm going to give 20 more seconds, otherwise I'll wrap up this short presentation. The conclusion is that we have really good potential trades coming. We have a G20 trade that most likely will materialize. And also, during the boring summer, we might have great opportunities of doing short vega trades. Okay, Jeffrey says, have you been collecting the cost of the spreads for future input to the NDLA? Yes, I have the cost of the spread, yes. I just need to retrain it. Those of you know that I'm very hesitant to retrain in the net because it feels like cheating. You know, if you retrain the net, that thing feels like you're cheating. Like you have future information that you're trying to feed into past information, and every time that we have a new net, it's like we have an unknown quantity. So right now NDLA Classic is kind of known, NDLA 2.0 is getting to be a known quantity, but if I train a new one with a new parameter, you know, it might have a tremendous theoretical edge, but we don't know yet how it will perform in the future. So that's why I'm a little hesitant to coming up with new nets, because I prefer old and familiar. I guess I'm very conservative in that sense. Anyway, thank you folks for joining me on this live video. As usual, send me questions through private, the little private thing, or you know, I encourage you to post the questions in the room because they can benefit everyone else too. And I'll be more than happy to answer your questions. And thank you again for spending this half an hour with me. Take care, guys.